Right, good evening, everybody. Thank you very much for coming. It's hard to believe that probably the last time we were talking to you was a couple of weeks before Christmas, and now it's a couple of weeks before Easter. How quickly the months go by. Right, I'm going to ask you a little quick question just to get things going. Who is superstitious? Who reads their horoscopes every day? Anybody going to admit it? Well done. One person who's going to admit it. Do they work or not? No? Oh, okay. Right, so are you superstitious? So 2025 is actually quite an interesting year. It's sort of got mathematicians and astronomers and astrologers all very excited because there are a couple of things about 2025 that actually make it, if you're a little bit superstitious, if you believe in cycles, if you believe in patterns, then this is quite an interesting year. And the first thing is that 2025 is a perfect square, so 45 squared is 2025. And obviously the next time that will happen, I think, is in 2116. Sorry, don't quote me on my maths there, but you can go and work out what 46 squared is quickly in your head and work it out. But it's also then the sum of the cubes from one. If you do 1 cubed all the way through to 9 cubed, you get to 2025. So that's got sort of mathematicians all excited. It was 2116. I see it's on my slide there. And then I don't know if you guys also followed the press, but a couple of weeks ago, all the planets were in a perfect alignment. I'm not sure we had a clear cloudless night to watch it because of the mist in this part of the world. But, if you take the sort of mathematical cycle and you take the astronomy and what the planets are doing, we have to ask ourselves the question of whether the stars are aligning. And this is, some sort of portent to what's coming through for this year. So we're going to do something a little bit unusual this presentation. And we're going to start off by giving you our best idea for returns for this year, our best sort of individual stock idea, and then we're going to spend the rest of the presentation justifying why we're doing that. All right, so our best tip is it promises to go where no man has gone before. And basically this is, there's a company in the US called Tuttle Capital, and they've just launched a new ETF called the UFO Disclosure AI-powered ETF. And if you look at the blurb underneath it, it's got all the right words, hasn't it? It's got AI-powered, it's got advanced, it's got reverse engineered, it's got alien technology, it's got classified technology in it, it's got groundbreaking achievements and advancements. And if you think this is our top tip for the year, then you haven't been with Harvard House for very long. I think for us, I came across this a couple of weeks ago, and if this doesn't tell you that there's some hubris and exuberance in markets, then nothing will. That is not our top tip. That I think is a perfect example of just how irrational markets can get sometimes. This ETF promises to trawl through government documents using AI and search through thousands of classified documents that become unclassified as time passes by and look for companies that are then exploiting alien technology. So I can give you, the share code is there, it's UFOD. If you want to go and buy it, you're welcome, but we're not going to be buying it for you. So I think it's probably time to come down to earth a little bit, get our head out of the stars and come down to earth a little bit. And I think we probably have to appreciate, what's really happened this year. Uncertainty has just risen exponentially. And I think, if you have a look at these two slides, the one on the left is essentially a global index, and the one on the right is the US index. And on the US side, you have economic policy in the blue, and you have trade policy in the red line. And if you just look at them, look at the absolute number for sure, but just look at the trend, and especially if you look at the US, and just look how stable policy generally is in the US. It doesn't really change. For the last 25 years, policy has been virtually unchanged, and it's been predictable, and everybody knows where they stand. And suddenly, in the last couple of months, no one knows where they stand. And I think we probably can all appreciate that, because I don't even think any of us know where we stand in this new world that we are living in. But I think it's worth bearing in mind. We often talk about how markets hate uncertainty, and we're now dealing with uncertainty on an unprecedented scale. And we also know what happens. I'm going to talk about it a little bit later. We also know what happens when you have an economy that's very uncertain. We experts at it in this country. But that uncertainty basically coincides with a period where the US has been exceptional for the last 10 years. So if you just look at the chart on the right, up until 2014, kind of global markets moved in tandem, which is kind of roughly what you expect. But ever since 2014, US markets have just outperformed. And the US has got kind of better and better at the expense of other things. And I mean, how many times have you probably heard on radio, on TV, on commentators, if you don't have all your money in the US, then you're an idiot, And it's because the US has been powering ahead for the last 10 years. And that's then coincided with the US now being 70% of the sort of market cap of global stock exchanges. So 70% of the weighting is now generated towards the US. So essentially there's quite a lot of concentration risk going on because the US has become so dominant relative to the rest of the world. And then you sort of coincide all that with lofty expectations. So the last couple of days has probably not slightly dated the slide a little bit, but I mean, there has been a bit more volatility in the last 3 or 4 days, and I'll talk a little bit about that in a moment. But the VIX index is it's actually sometimes called the fear index, and it's an index that measures how much it costs to put downside protection on your portfolios. If you want to hedge your portfolio and make sure they don't lose any money, then the VIX index is essentially a gauge of that. And you can see what happened to the VIX index in COVID. So if you go back and think about my uncertainty slide, we have more uncertainty now than we did in COVID. And yet the markets are remarkably complacent about it all. So there's been a little spike up in volatility, but nothing out of the ordinary than what we haven't seen in the last sort of 4 or 5 years. And it coincides with a time where US companies are at record levels, valuations are at record levels. That's the chart in the middle. And the chart on the right really shows you almost the same thing, but it just shows it to you in a different way. It basically shows you where the sort of PE ratio is over the next 12 months relative to its 15-year average. So if you look at the chart on the middle, you can see, and then you look at the chart on the right, you can see the US right in the top little corner there. And the US is pretty expensive at sort of 24, 25 times, which kind of coincides with where the chart on the left is. But you can also see that relative to the last 15 years, it's at a significant premium to where it has been. So you've got all this uncertainty, probably the most uncertainty we've had probably in our generation, probably the last 30 years. You've got US markets having performed very well. You've got markets being quite expensive and yet being pretty complacent about it at the same time. So it's an uneasy situation. It's not what you would necessarily expect. It's a little bit uneasy, and kind of your gut feeling is that something's got to give in all of this. So this slide is actually a very difficult slide because every day it changes. And the first thing you have to do in the morning is when you wake up is go and check the news and update it because something else has happened overnight to change what the tariff situation is. And this is basically a quick little summary of what's going on at the moment. So America has put tariffs on Canada, 25%, except on energy. On Mexico, there's tariffs on China. There's been 2 lots of 10% in the last sort of 4 weeks. So 20% on China. There's 25% on steel and aluminium. And then also Trump is proposing other tariffs. He's proposing tariffs on cars, on copper, on semiconductors. Semiconductors are the little chips in computers. He's also proposing universal tariffs. So that's just a flat 10, 20% on every single import that goes into America. And he's also talking about reciprocal tariffs. So for argument's sake, if we have a 20% tariff on some American goods that are coming into SA, he will put 20% tariffs on all SA goods going into America. Sort of tit for tat kind of things. So you can see on the right-hand side that economic sentiment in America is just deteriorating. And the problem is, on the tariff side, is that obviously countries are retaliating. Why not? Why should they just lie down and take whatever Trump throws at them? So Canada's put reciprocal tariffs on the US. Mexico's thinking about it. China's put tariffs on the US. But you can just imagine how in the last 6 weeks, the cost of shipping things around the world has risen incredibly. Because you don't really know what the tariff is going to be and whether you're paying the tariff when it leaves the port in China or whether it enters the port in America. And that could be a couple of weeks on the ocean. Also, so just the paperwork around trade is getting more. It obviously raises the cost in before you've even taken into account the tariffs themselves. It's just getting more complicated. And the problem is that these are changing almost daily. The other day, Canada said that they were going to put 25% tariffs on electricity that they sold to America. And Trump responded within an hour and said, okay, well, your 25% tariffs on steel and aluminium are actually going to 50% tonight. And then later that evening, both sides backed down. But actually, think about it from a business owner's point of view. How do you plan? How do you know where you stand? How do you make a decision about what to do in your business when you actually have no idea what tomorrow is going to bring? And we are experts in this country of adopting the wait and see approach, because we've been waiting and seeing for 15 years. Let's wait and see what happens in the election. Let's wait and see what happens with the ANC conference. Let's wait and see. Let's wait and see. And whatever the problem with wait and see is that you end up not doing anything because you're paralyzed by indecision and you're always waiting and seeing. And that same sort of little attitude is now creeping into the US. So the US is at an interesting inflection point because I think there's a growing risk that the US is heading into a recession. JP Morgan, we think, has got one of the better economic forecasting units around the world, and they've raised their probability of recession from 30 to 40%, which is not insignificant. 40% is pretty high, and obviously these things are changing all the time, so we might find it's at 50% by in another couple of weeks' time. But on the one hand, you can definitely see that this indecision, this uncertainty, is starting to affect the way people operate. So you've obviously got all the tariffs, but you've also got Musk and his band of merry men going through the government with a hatchet, a cleaver, a scythe maybe for some people, and just cutting jobs, cutting expenditure. Now, not all of that is bad. We might look back in a couple of years. I don't think any of us would argue that governments around the world are bloated, they're inefficient, they need cutting down. I see some people nodding in the audience, and I was interested to read on the weekend that the UK is also talking about cutting their bloated civil service over the weekend, and saying, we've got to cut the size of the civil service. So in some ways, what Trump is doing, we might turn around in 3 or 4 years' time and actually applaud him and say, thank goodness someone actually got the ball rolling, because goodness knows that we could do with some cutting of our government down here with a chainsaw rather than some garden shears. We can talk about the budget a little bit later. But so on the one hand, you have got all this uncertainty. You can see it in rising unemployment claims. You can see it in consumer confidence. People don't really know where they stand, and they're getting quite defensive, and they're making conservative decisions. But on the other hand, you've got a situation in America where Trump is trying to cut government spending. If he succeeds, he's going to cut taxes later in the year, because that's one of his policies, that he wants to cut taxes and obviously stimulate the economy. Obviously, also, it'll probably redirect some of the government spending towards more productive areas. In addition to that, American companies are falling over themselves to be patriotic and to start reinvesting in America. So almost every day we have an announcement from one of the big S&P 500 companies. They're building more factories in America. They're shifting some of their production back. And, we can sort of smile about it here, but it's almost, if you don't, you're not patriotic. And that's almost the way Trump makes you feel, is that, yes, if you're not on board, you're either my friend or my enemy. And, you need to get on board. And big CEOs, I think, are probably quite terrified of being Trump's enemy at the moment, so they're quite keen to get on board. And so we could have this absolute boom in infrastructure in America that starts to feed through in the next couple of months. So the next 3 to 4 months in America actually look pretty dodgy. I think things could slow down quite rapidly. But it's not clear at all what happens maybe from the fourth quarter of this year onwards. We could go into 2026 with a very, very strong American economy, or growing quite strongly. America would again be the place to be. It could go either way, and I don't think anybody has any idea which way it's going to go. And so it's pointless trying to predict it. But what we do have to be is open-minded to react to what's going on, because everything could change next week. This presentation could be out of date, but we'll just have to adapt to that. That's how quickly things are changing. The one interesting thing that is also happening, though, is that Trump definitely wants a weaker dollar. You can see in the middle the trade balance, and this is why Trump is so upset with the world, is he because their trade balance is getting bigger and bigger, and this is monthly data, so all those little bars is 1 month. And he's very upset that he thinks that basically the US has been giving everybody else a free ride, and everybody's been exporting goods to the US, and the US is not getting their pound of flesh from the rest of the world. As one commentator pointed out today that I was reading, what the trade balance doesn't take into account is the services that America generates and exports to the rest of the world, especially digital services, from the likes of Amazon and other things. So the trade balance is maybe a quietly narrow view, but this is what Trump is focusing on, and he's very upset that it's such a big negative number. But you can see that the dollar's got progressively stronger over the last 10 years, and obviously when the dollar gets stronger, currencies on the other side of the seesaw get weaker, and that makes them more competitive when they're exporting. So Trump is very keen to weaken the dollar, and actually that's not necessarily a bad thing either, because if you do have a weaker dollar, you will have company earnings getting boosted. So companies in America will make more profit, because most of the big companies that we look at are multinational, so they export a lot, which is obviously good for them. A weaker dollar would be good for that. And they also sell a lot of their products overseas. So when you translate all that money back into dollars, they're going to make more money. So a strong dollar would actually be quite a nice tailwind for American companies, and it would drive markets higher over there. Obviously, the negative side of a weaker currency is always that you're going to have probably higher inflation coming along with that. And obviously, you've got higher inflation coming from tariffs, and then you'd have higher inflation coming from a weaker currency. So you have to assume then that the Federal Reserve is not going to cut interest rates a huge amount this year. They're certainly going to be in a wait-and-see mode to see what the impact of all this change is before they start cutting interest rates aggressively. And that could put some pressure on America. So that's why I just say America's at a real inflection point, and we could have a couple of months where it's quite weak, but I don't think we should write America off. I don't think we should write the US markets off, because they actually could come back next year almost as strong as ever. And as I said, if we look back in 3 years' time and Trump has changed the narrative around big government and he's made the US more efficient, I think we'll all actually be pretty grateful for that, because the whole world can probably do with a slimming down of big government. But it's not all about the US. There's actually a lot of stuff going on elsewhere in the world as well. I've already talked about the first slide, and that's just the other side of the seesaw relative to the dollar. You can see that the euro is strengthening and the pound is strengthening against the dollar, which is probably about time, because they've been quite weak for quite some time. But if I'd said to you, before you looked at these slides, that if I'd given you a quiz tonight, I'd given you a quiz and said, which do you think would have performed better over the last 15 months, European shares or American shares? I guarantee everybody would have said American shares, because that's been the narrative out there. But actually, European shares have performed just as well as American shares. And what's even more interesting is that Chinese tech companies, things like Alibaba and Tencent, have performed better than the Magnificent Seven over the last 15 months. And you certainly wouldn't have said that if I'd given you a quiz. So you're lucky I didn't give you a quiz. Otherwise, there would be no drinks tonight. You guys wouldn't have passed. So the drinks would be off. But there's some interesting things going on in the world. Obviously, there's quite a lot of change in Europe. There's been new elections in Germany. There's obviously a bit of a renewed focus in Europe to try and come up with their own solution to the Ukraine problem. There's a renewed focus on defense spending in Europe. Germany's talking about relaxing its debt rules for the first time to try and stimulate its economy. And again, as we've said so many times, always with markets, it's always about what actually happens relative to expectations. When expectations are pretty low, you don't have to jump very high to beat them, and then the markets actually perform quite well. So you can write something off and think, well, that's a terrible investment. But when things start to change and expectations are pretty bombed out, that's when there's a real opportunity to do something a little bit different. And even the same thing in China. So China's been pretty much a disaster for the last couple of years. And you might remember back in 2021 when they were coming out of COVID, that China took to task its big IT champions. I mean, the CEO of Alibaba, who's a chap called Jack Ma, he was called in and he was read the riot act and he disappeared for a couple of weeks. And no one was quite sure whether he was at the bottom of a lake or where he was. And basically the message from China was, you guys are getting too powerful. Just remember who's actually in charge here. It's us, and we're putting you back in your place. And China really clamped down on its tech industry. They made life very difficult for their for their tech champions. But in the meanwhile, these guys just go about their business. They do their job every day. They build platforms. They build cloud and whatever, and AI. And obviously, in the last couple of months, with Trump getting so belligerent, and then obviously DeepSeek being announced. Sorry, I apologize about that. That's a proper fine as well. I think China's realizing that they need their tech champions to compete with the US as much as anything else. They need their champions to be on the front foot. They need to compete on AI. They can't be playing second fiddle to the US. So China's welcomed all the tech giants back into the room, and they're getting more support. And obviously, China's attitude towards its own economy is starting to change a little bit. So yeah, China's been a bit disappointing for the last couple of years. But we see quite a lot changing in China, and having been maybe a drag on portfolios for the last year or two, I think the message here is that don't write off things just because they haven't performed well in the past. Times are changing around the world. So how many times have you heard that phrase, there's a new sheriff in town? If you listen to any speeches or any televised interviews with J.D. Vance or with Trump or with Rubio, they use this phrase all the time, and there's a new sheriff in town. So that's the best picture I could find of Trump with his Wild West hat on. But I actually think we have to take this quite seriously. So we're dealing with multiple changes in the US. And I think one of probably the biggest mistakes we can make is to think that this is just that Trump is actually just shooting from the hip, that he's got no plan, and that this might all be over in a couple of weeks. We actually don't think that's the case at all. We think that this is a very deliberate, very well thought out strategy on multiple levels that Trump is actioning, and he's got his whole cabinet behind him. He's obviously appointed his cabinet because they are people that believe in the same strategy that he does. And we think that this has got quite a long way to go. So when Trump was speaking to Congress about 10 days ago, he probably said 10 or 12 times, we are just getting started. And I actually think we have to take that threat quite seriously. So the world is not going to necessarily be the same as we have had in the past. We're obviously dealing with changes on trade policy. We're dealing with changes on foreign policy, obviously with Ukraine and Gaza. And I'll talk a little bit about us at the end. But there's also obviously aggressive cost cutting in the American government, which, as I've talked about before, we might look back on, and that might be Trump's lasting legacy, that he turned the tide on big government, a little bit like Margaret Thatcher did. I mean, she's remembered quite fondly for that. Trump's also rolling back wokeism and political correctness. And again, we might look back in a couple of years and say, thank goodness for that. Where was the world going? It's actually probably worthwhile going to listen to a speech that J.D. Vance made to the European Security Council about 3 weeks ago. And he was basically saying to them that your biggest problem, your biggest threat in Europe is not from Russia or anything like that. Your biggest threat is yourselves, because in Europe, free speech is really being rolled back. He cited about 5 or 6 examples in the speech that I'm not going to go into now, of examples where people in Europe have been jailed or prosecuted for absolutely innocuous things that 10 or 15 years ago would have not even been an issue, and now you're being jailed for that because there is no freedom of speech. And he was basically saying, I'm not sure that we're going to be your allies anymore if you don't have the same values as us. Now, and he's really talking about freedom of speech and democracy there. And so, yeah, I think the world is changing, and there's pressure coming on things that have, the world's been moving in a certain direction for the last 20 years. And there's definitely a shake-up coming. So don't just assume, I think, that the next year or two are going to be fitting back into the old mode. I think we're in for an interesting time. So how do we actually cope with this? How do we manage portfolios and all this? What do we do? In our opinion, you have to have balance. You can't have everything. You can't bet all your money on one horse. I mean, how many times have you probably listened to the radio or TV or commentators in the last couple of years where if you haven't been invested in the Magnificent Seven, are you just living under a rock? I mean, what are you doing? And there's some wonderful companies in the Magnificent Seven, those tech companies, but it's not the only thing in town. And if you don't have balance in your portfolio, then you are very susceptible to these very unpredictable changes that really come out of the blue. If you think about when DeepSeek was announced on that Sunday night, I don't know where it was, 6 weeks ago, NVIDIA lost $600 billion worth of value the next day because no one saw DeepSeek coming. The Chinese came out of nowhere with DeepSeek, and now they launch, 6 weeks later, they've launched one or two other AI models in addition to that. So just don't, in a very, very unpredictable world, the worst thing you can do is be too concentrated. You need to have a diverse portfolio that can sort of slightly roll with the punches because you don't know where the next punch is coming from. So you would have seen this slide before. It changes quite a lot because this is what we do at the office, and we move things around, but we've got kind of 5 themes that we think are prevalent at the moment. The one is just sort of, you're always going to have your cash flow, what we call cash flow champions in a portfolio. A company like, I'm just going to single out Visa as an example. Visa doesn't really matter what Trump is doing. Yes, they might be a little bit affected if we only swipe our credit cards 5 times a day instead of 6 times a day. But at the end of the day, Visa is a wonderful company with almost an unassailable position, Visa and MasterCard, and they just keep on going. And the cash flows are so robust, the dividends are so robust. Yes, the share price can fluctuate, it always will, but actually the underlying business and cash flows are just, they're just not variable at all. So if you're relying on Visa for your dividends or something like that, you can really sleep very well at night because there is ample security in that, even if the share price is fluctuating. So you're always going to have that group of companies. Obviously, health and wellness, we think healthcare and wellness is a big theme. You would have heard us talking last year about the GLP-1 drugs, the weight loss drugs. But I think health and wellness, especially for younger generations, is becoming much more of an issue. Younger people are certainly thinking differently about their health. And, we wrote a couple of weeks ago about alcohol consumption and intuition, and younger people appearing not to drink as much as maybe our generation. Shame on them. They don't know what they're missing out on, but they might come round. And I'm going to talk a little bit about infrastructure in a moment. I've talked a little bit about China, and you're always going to have this the sort of fintech theme and the digitalization and the big data. That hasn't really changed. But I just want to now dive into maybe sometimes how we think about things. And I think sometimes it's quite easy when you read the news or you look at some of the commentary in markets to focus on all the household names that are in your face all the time. And, those might be all the big tech giants that I've talked about already. But actually, there's stuff sort of going on underneath the scenes that is kind of where we focus. And we think that presents other opportunities where you can buy into companies that are maybe cheaper, have more robust cash flows, and are maybe a little bit less risky than investing at the maybe the sexy end of the sort of curve. So I'm just going to sort of also, this is sort of centered around AI a little bit and data centers, but the chart on the left just shows how much money those big 4 American companies spend every year on capex. And a lot of this is going into data centers, it's going into cloud infrastructure, it's going into building the ecosystem that just keeps on getting bigger and bigger. And you can see that sort of $320 billion, just those 4 companies alone this year are going to spend $320 billion on their infrastructure. And most of that's going into data centers and cloud and things like that. And then in the middle, you can just see what's happening to power demand. So obviously data centers are very power intensive. So you get non-AI data centers, which are just maybe if we at Harvard House store all our data in the cloud so we can access it easily and save on our networking costs, then that's a non-AI data center. It's storing all our data and we can access it. But when you have an AI data center, that's where you type in a little message in Perplexity or ChatGPT and say, give me, write this essay for me if you're at school or university, and it spits out an essay for you. All that processing is happening at an AI data center, which is consuming huge amounts of power because there's thousands of chips processing that, finding all the information, writing something, getting it in the right grammar, and all the other stuff that's going along with it. And that's all happening in maybe a minute or a couple, less than a minute. So there's a huge amount of processing power, and that requires a huge amount of power. But in addition to power, what you actually also need is you need infrastructure. So we are so aware in this country of failing infrastructure. It's lucky that the lights are on tonight. But actually, the whole world is guilty of not investing in infrastructure. No one has maintained electricity grids, water for that matter as well. And so Vinci is a French company that we quite like. We spend a lot of time looking at them, and they estimate that you need $600 billion per year to upgrade electricity infrastructure around the world. Networks, grids, transformers, base stations, all that kind of stuff. And that's, I mean, not even a fraction of that is being spent at the moment. But when you have this accelerated growth in electricity usage from data centers, from electric vehicles, from all the other bits and pieces, the whole infrastructure is just creaking. And we just think that playing in some of the other things where it's sort of a bit like the shovels in the gold rush. You can go and buy the NVIDIAs, which are at the cutting edge of the AI, but you can also go and look at investing in some of the things that are providing all the infrastructure that's making AI happen. Who's building the data centers? Who's supplying them? Who's building the electricity grids? Who's supplying the transformers? Who's supplying the copper cables? All that kind of stuff that's going on. So you can just see how much of a deficit there is coming in copper. By 2030, it's estimated that there'll be a 4 million ton deficit. Demand will exceed supply by about 4 million tons. Now, copper and aluminium are quite interchangeable, so some of that would go to aluminium. But even if you have a 1 million ton deficit in the next sort of 5 or 6 years, 1 million tons is 1 million tons, and a deficit is a deficit. And then the price rises to the sort of marginal price at where the market is satisfied. So we quite like copper. The middle chart just shows a chart of sort of how much profit comes from copper for all the big different miners. Rio looks a little bit low, but Rio also actually has aluminium. So if you add aluminium and copper together for Rio, it comes out at about 35 or 40% as well. So that's, I think, for us, one way to invest in things that you look a little bit deeper than what's happening at the surface and look for other opportunities, that I say are cheaper, that are providing some more substantial cash flows and more predictable cash flows than maybe the headline names. And the other example I just wanted to show was basically really around about chip manufacturers, so semiconductors or chips, all the little stuff that goes into all these computers. So chips have basically got more and more clever and smaller over the years. So the chart on the left basically shows how much smaller chips have got. They started off at 90 nanometers, and now they're at 5 nanometers. And you can go and Google how small 5 nanometers is, but it's so small, hard to explain. But you can see that as chips get smaller and smaller, and there's more complexity in a chip, the amount of steps in the manufacturing process gets bigger and bigger. So now to make 5 nanometer chips, there's 1,300 steps in the manufacturing process. That's a very complicated process. And the chart on the right basically shows that as chips have got more complicated, fewer and fewer companies can actually have kept up with the technology to make those chips. So TSMC, which stands for Taiwan Semiconductor Manufacturing Company, is the only company in the world now that can manufacture chips at 3 nanometers. They're the only ones that have kept up with the technology to be able to manufacture at that level. And that's 3 nanometers is kind of the cutting edge of chips where we are today. But you can see that whole bracket that I've marked EUV is what's called extreme ultraviolet. And those are essentially where you need extreme ultraviolet light to refract the lasers and etch the chips with thousands of transistors and things. I'm not going to go into all the technical detail because it is very technical. But all you need to know is that that whole bracket is extreme ultraviolet. And there's only one company in the world that makes the machines that can do extreme ultraviolet manufacturing, and that's ASML. So again, NVIDIA's role is to actually design the chip. They design the chip, and they design how many transistors are going to go in it and how the electricity is going to flow around the chip. Then they send it to TSMC in Taiwan, typically, or Samsung or someone like that. And that company actually makes the chip. They manufacture it. And TSMC goes to ASML and says, we are building a new factory and we need some new machines for this factory, and ASML have to supply them. But they are the only company in the world that can supply these machines. They literally have a 100% monopoly. So it's not to say that any company is risk-free, and it always comes down to whatever price you pay for an investment. But it just sort of shows, so obviously as ASML sells more machines, they start to earn some service revenue, because when they install a machine, they send a whole plane load of engineers with it, and it takes them 6 months to assemble it at the client's factory, and then they have to service that machine for the next 20 years. So as they sell more and more machines, then they have to service those machines, and they get, obviously, you can see the light blue bar, that portion of their revenue is getting bigger and bigger. And that's kind of like the holy grail for a lot of companies. Selling machines is quite lumpy. If no one's building a factory, you might not sell many machines. But when you're servicing those machines every year, and that's annuity income, that's obviously worth a lot more money to the company and to shareholders because it's much more predictable. So we think, again, don't always be caught up in if you're around the braai and someone says, why don't you have X, Y, Z in your portfolio? You can just smile and say, oh, well, there's other ways to invest in this theme rather than, whatever they're talking about. So that's really concludes the sort of global portion. I just wanted to have one slide on kind of how this impacts on us, because I'm sure I'm going to get a question. So I'm going to try and preempt it with a slide. So there's a website called The Visual Capitalist. It's a wonderful website. They draw all sorts of wonderful charts where they graph different things. So this is a graph of the world economy. And I don't know if anybody, the audience this morning was a little bit younger, I have to admit, than the audience tonight. And one chap can anybody see where South Africa is on that chart? No, well, we're right up in the top corner, right up there, the very top corner. I can't even read it here, it's so small. But I think our GDP is $418 billion, according to the Visual Capitalist. But you can see that whole green column is the whole of Africa. Obviously, Asia is the orange bit, and so it goes around the whole world. But you can see how small we are. So where does this really leave us? What's happening in the world? Where does this kind of leave us? So on the one hand, as I said before, a weaker dollar would actually be pretty positive for us because the rand would strengthen a little bit and our terms of trade would improve. And it's especially important because a weaker dollar typically implies stronger commodity prices. But the other thing that Trump has got it in for is the oil industry. Trump basically has this view that he's going to create inflation by pushing through tariffs. But if he can get the oil price low enough, that will be counter-inflationary, and then people won't notice so much the inflation coming through on the tariffs. So he's really got it in for the oil industry, and oil prices have been under pressure, which is actually great news for us all. The rand price of oil is back to sort of where it was in August, September last year, and we should start to see petrol price cuts coming through next month for us, back down, maybe R1 or R1.50 a litre or something like that, which obviously is stimulatory for us. And the government didn't put up the fuel levy in the budget yesterday, which I think is the third year, might even be the fourth year in a row that they haven't put up the fuel levy. So it's not all bad in the budget. But obviously, if we have stronger commodity prices, coupled with a weaker oil price, that's almost the holy grail for us in terms of our imports and exports. That would be beneficial for our terms of trade. It would give the Reserve Bank scope to cut interest rates and to keep our cyclical recovery going. And obviously, hopefully, the reforms that the government are doing can underpin that. And that's what we've been saying for the last year, and hopefully that momentum can continue. But we have to acknowledge that in the last couple of months, things have got a little bit more difficult. And I was saying to everybody this morning, I don't even have to ask here tonight that I know that every single one of you has read Intuition from last week. I don't even have to ask because you are such a dedicated client base. But if you haven't read Intuition for last week, I was basically writing about don't poke the bear. And unfortunately, we seem to be poking the bear at every opportunity at the moment. We're provoking the US almost, it feels like, at every opportunity. So Trump has got it in for us. We are of the opinion that there's a bigger issue at play here. It's not really anything to do with Musk or the fact that Musk is South African or that he maybe wants to launch Starlink down here and he's coming up against some BEE legislation that he doesn't like. We kind of think it has a much bigger global impact than that, and we kind of feel that it's all about the power within the BRICS sort of grouping of countries, and America wanting to reassert their dominance in the world. Russia, China, India have certainly got a lot closer together as a group of countries over the Russian war. And I think Trump is actually trying to break up that grouping a little bit and weaken its status. So we might just be a pawn in a much bigger global game of chess, which would be very unfortunate because it might derail some of what we're doing down here. But we shouldn't be going out of our way to provoke him and to pick a fight. And I think, unfortunately, I'm sure the diplomats are working behind the scenes, but I think we have to probably acknowledge that the risk has risen a little bit that we could be on the receiving end of some US punishment, as they like to call it. If we do lose some trade benefits, we're probably going to see the rand weaken a little bit. We'll see that usual loss of investor confidence and the associated risks. So Listen, I don't think it's our bear case, but I think we have to acknowledge that relative to 3 months ago, that risk has risen that we fall foul of the US. And so how do we really cope with that locally? We have companies here that are, well, we invest in companies here that are very resilient. That's how you cope with it. So if we have good times, they will do well. If we have tougher times like we've had for the last couple of years, they will continue to do well. So it's not the time to maybe be investing in fringe companies or little things where you're taking a punt. It's to be invested in big, strong, defensive companies that have survived the last 10 years and profited very well, and who can do exactly the same going forward. And if we start to grow again, that's great. If we don't, well, then at least they can continue to weather the storm a little bit. So I don't want to be too doom and gloom. It's not our base case, but I think we just have to acknowledge, we just have to see how things unfold over the next couple of months. And I just come back to my comment earlier about Trump saying that we're just getting started. I don't think we could just assume that Trump has just got a few things up his sleeve. I think there's a long plan of action that he knows he's only got 18 months or 2 years to implement, and he's got a plan. He's a man with a plan. So we just need to bear that in mind. So that's all I really wanted to say. I know that it's been a long, hot, thirsty day, and you're dying for a drink, so there won't be any time for questions tonight, and we can just go straight on to drinks. Now, I'm very happy to answer questions if there are questions. Oh, you're going to let me off lightly today. Oh, Daryl. Just when I thought I got away with it. Sorry, I didn't hear the last bit. Listen, they were, and Anglo did have quite a lot of problems, and unfortunately, Anglo has quite a different suite of commodities to some of the other miners. Diamonds and platinum set it apart, and the diamond market has been particularly weak in the last couple of years. I think there's been a bit of oversupply, and I think the whole industry's underestimated the impact of synthetic diamonds and how popular they are becoming, and especially with young people. I mean, I think young people are really questioning the value that they get from things, and they're asking, why must I go and spend $20,000 on a real diamond when I can go and buy a synthetic diamond for $1,000 that looks the same, feels the same? Yes, I mean, maybe she won't even know, because if I don't tell her, you can't see that it's not different. But even the bride is questioning, why should we be spending that money on a diamond when I'd rather spend $20,000 on an experience or a honeymoon or something like that and spend the money differently. So Anglo's had a really tough time on the diamond side. Obviously, platinum has been in a tough space for the last couple of years because of the rise of electric vehicles. And so Anglo found itself, much weaker than the rest of the miners because of its commodity mix. BHP decided to pounce. That galvanized Anglo into action to say, listen, we don't need to be bought out. We can unlock value ourselves. And obviously, they're about to unbundle Anglo Plats. They're going to do something with the beers. They haven't quite decided yet. And Anglo is going to end up being a very focused copper, iron ore, and fertilizer business. Very similar to BHP, not similar to Rio. So I think there was quite a lot of value in Anglo. Some of that value has already been realized because the Anglo share price has reacted to that. And now I don't think that it's actually at a level where it's attractive to BHP anymore. So I don't think Billiton BHP is interested in making a bid anymore. But if the Anglo share price really weakened, there probably would be other bids on the table, because Anglo is a much smaller mining company than BHP, Rio, even Glencore. And I think probably what I didn't say in my chart earlier was that there is a worldwide shortage of copper, and all the big mining companies are looking for ways to grow their copper exposure. And it probably takes at least 10 to 15 years to build a new copper mine. Even if you found the deposit, you're still going to take you 10 years to get all the permitting and actually to build the mine. So it's actually a lot easier to go and buy another company that's already got mines operating. Yeah. Okay. Thank you very much for coming, everybody. It's obviously still raining, so please drive home safely when you do leave. We really do appreciate you coming out. It's hard to believe that we're facing Easter in a couple of weeks, how quickly the year is going by. But we look forward to keeping you up to date over the next quarter. And maybe the parting message is just expect the unexpected, and smile when you see Trump's face every morning on the news. Thank you.